Yeah.
Oh yeah,
That's nice.
it's a remix today.
Yeah. All right. Welcome back to the I Love Annuities podcast. I'm Jeremiah Conger.
And I am Zachary Van Ness, and together we are the
Oh,
Annuity
Annuity
Dude.
dudes. What'd you think about that new intro music there, Zach?
Dude, adapt and overcome. That's all we do.
Yeah, that's it. That's the name of the game, and that's what we're here to help people do as well with their retirement and get their plans on the right track. So, real quick, we had to adjust to an outage on our normal streaming platform. So we had to pivot and find another resource, which we did. But then we realized that we were going to be without our intro music, which we have grown fond of. But we quickly found a new intro music, which is, I don't know, man. What do you think? I kind of like it better. I don't
We
know.
could rotate. I mean, we're going to get lyrics here soon, so we got to determine which song. Maybe we do a vote on the website.
Yeah, we should do that. We should open up the polls and see what our audience thinks. But today is all about a very important topic. We're diving into a specific topic that affects every retirement plan and everyone, whether you're 50 years young or 75 years young, and that's the economic environment.
That's right. We're talking about interest rates, inflation, and really how they impact pricing and the purchasing power of annuities.
And more importantly, how you can build a strategy that's resilient no matter what the economy throws your way. So, we're really going to try to make the focal point of this episode on how not just the economic environment and the impact it has on someone's financial future, but also how those economic changes, specifically interest rates, can affect annuity pricing and annuity rates in general. So that's going to lead us right into our first segment, Zach, and why economic conditions matter in retirement.
That's right.
So,
Go ahead.
yeah, sorry. So what, whether you're still working, or what rather when you're still working, okay, you have time to recover from economic dips, but in retirement, every dollar has to count. And the economy has a direct impact on how far those dollars go in more ways than one.
Yeah, exactly. And retirement's no longer just about growing that money. We talk about an accumulation phase, but it's no longer just about growing that money. It's also about preserving, protecting that income that you do have and staying ahead of any inflation.
And annuities, when used properly, which we've discussed numerous times in previous episodes, we know and can prove scientifically and mathematically that they're incredible tools in retirement. And don't forget about that, the psychonomic impact that they have and how they benefit somebody. But like everything else, they're impacted by the broader economic environment. So let's start with one of the most important pieces, and that is interest rates.
Yeah. So with annuities, especially these fixed annuities and income annuities, really what we focus on, they are directly correlated. We do find a direct correlation to the interest rate environment and how these annuities can pay out a lifetime distribution or how they can provide a guaranteed rate of growth.
And that's because these insurance companies that deploy these annuities and put them on the marketplace, they essentially take that premium from that investment in that annuity. And they go out and they go to the bond marketplace and they invest it in high quality, high grade bonds. Usually it's going to be in a corporate bond or a treasury or other conservative fixed income assets. Sometimes they'll invest in mortgage backed securities of some sort or even loans on mortgages with high quality, uh, high prime credit profiles. So these investments back the guarantees that they offer you. And so when you look at the interest rate environment, if interest rates are high, then it can obviously have a direct correlation to the annuity that you may be buying. And same as if it's low, it can have a direct impact on the rates that you're securing in that low interest rate environment.
Yeah, that's right. So really what we're looking at in most cases, more often than not, is going to be that 10-year US Treasury yield. So we correlate that also with the interest rate environment. If we look at mortgage, we see oftentimes mortgage rates are correlated to that 10-year Treasury as well.
Yep, and that's definitely going to be one of the biggest benchmarks to track is that 10-year Treasury and its impact and influence on bond yields as a whole. So, as an example, if the 10-year Treasury is sitting at 4.5%, the insurance company can generate more yield, which means higher annuity income payouts, better crediting rates if it's a growth oriented annuity, and more competitive guaranteed terms overall.
That's right. But when it drops, let's say, for example, drops down to 1.5%, those yields then shrink and annuity payouts also come down with that.
Yeah, so I think this would be a great opportunity to kind of showcase exactly what we're talking about and how the interest rate environment correlates to the annuity rates that are available on the marketplace. So, for those that aren't familiar with our firm and our organization, we are annuityassociation.com. We are an independent annuity advisory firm that helps people make better annuity buying decisions. And we do that through education and transparency to ultimately help you and empower you to make a better decision and help you ultimately hand pick which annuity is right for you. And we hope that with that experience, you'll choose to buy that annuity through us, which is how we are compensated. But because of our ability to look at the annuity marketplace and do so with a very broad lens because we have relationships with every major annuity provider in the United States and we have access to hundreds and hundreds of different annuities out there. We've been running reports on these annuities for many years. And that's given us the ability now in this specific podcast episode to be able to showcase real world examples of what annuity rates were 5 years ago. So we're going to go back to 2020 and I'm going to pull up a screen share, which will show a report that I ran for somebody that was requesting a free annuity report, which is available on our website. If you're wanting to look at annuities and start to see what the rates are, we can help you. And you can just go to our website, request that free report, and we'll send one out to you within 24 to 48 hours. But we've been running these reports for many, many years. And so I saved those. I used to be the one when we first started, right? Running the reports and sending them out. And I would send out hundreds a day. And so I have a folder still that has all of those old reports in it, dating back many years. But we're going to pull one up in 2020 and we're going to look at two types of annuities. And then we're going to do a scenario, a comparison of going in real time to the annuity marketplace today, inputting that same data, so the same age, investment amount, and deferral period if it's an income annuity. And we're going to look at the comparison and the differences between an annuity for income 5 years ago and an annuity for income today using the exact same criteria. And then next, we'll look at just the fixed rate annuities, or what are often referred to as multi year guaranteed annuities. And we'll look at what those rates were 5 years ago and what they are today, real time. So, since we are using a new platform, bear with me. I hope I can figure out how to do that. I should be able to. So, let's see. We'll go to screen share, and then I'm going to pull up in this PDF and let me know when you can see it, Zach.
Yeah, I can see it here. Yeah, this will be a great exercise just to see what kind of changes we've seen in the annuity environment in 5 years. I love this.
And it's actually going to be pretty impactful, the difference, right? And what somebody could get today versus I'm trying to make it a little larger. Is it big enough?
Oh yeah, you're
Okay.
good.
So in this report, we sent this out on January 15th of 2020, and this was for a 59-year-old male located in the state of Florida, and this was structured for single life payout. So this is an indexed annuity or fixed indexed annuity with a lifetime income rider. And this report was based on $1 million in investment premium. And then the client had requested to defer that income stream for 3 years. So he would start the first withdrawal at age 62. And so here is the report. And on the far right, the column there, annual guaranteed income. That is the amount that the top annuity at that time would pay. Now, when I say top annuity, I'm referring to for that specific situation. What most people don't understand, and one of the oftentimes frequently asked questions is, well, what is the best annuity out there? Well, that's going to differ, especially if it's an income annuity. It's going to differ case to case. And what might be the best annuity income amount for one person could differ for another person. And the reason is because part of the factors that go into this equation is the age of that person at the time of income election, as well as if it's single or joint life. And then also whether or not they're located in a particular state. Like all of these variables go into the answer. So it's not a static answer for everybody. It's not a one size fits all. It's going to differ. And oftentimes, what we see too is that it can differ if someone defers 1 year. Like if they defer 3 years instead of 4 years, the income could be substantially different, but also the option of which annuity is at the top could vary as well. So in this case, Prudential with their SurePath income product, which is a fixed indexed annuity with a lifetime income rider, would have paid out $65,431 on this person's initial $1 million premium investment. You'll see National Western Life was second at 64,827. So now, did you want to add anything there, Zach, before I go into
No, I
the?
would just say, a good amount of information on the screen here. Really, what we're trying to focus on is what the highest income guarantee amount is. So you could read through and scroll through different columns here and, get a little bit lost in some of this information. But really, the example we're trying to show here is what's that income amount that we have guaranteed from 5 years ago.
Yeah, exactly. So, um, I'm trying to see if the date was put on here. Here it is, prepared on
There you go.
1/15/2020.
Yep.
Okay. So just to add the credibility there that this is a legitimate quote. So now coming into our tool, so we already pre-populated this information to save some time, but this is our annuity calculator that houses all of the available annuities on the independent annuity marketplace.
Zoom in one more.
Okay. Oop.
There you go.
And what we use this for is to help people understand which annuity is going to be right for their situation. So if this is an income play, we come in here, we'll already pre-populate all the information if we have it. But we have 59 years old, $1 million, annual payout, single life male, deferred 3 years, activating income at age 64. And we'll see the same exact product, which was second on the 2020 quote, is now number one on the 2025 quote. It's National Western Life. But look at the difference in income, $92,378. This is an apples to apples comparison. So we'll go back to the original. That same product back then was paying out 64,827, and now it's 92,378. That's pretty substantial. I mean, that's got to be what, 133% more income.
Yeah. 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 And really telling that these carriers make these adjustments with time. This isn't just, oh, one carrier happened to have a higher income guarantee. So, they must not have made adjustments over the course of 5 years. These carriers are making changes as time progresses based on the environment we're in.
Exactly. And now I will tell you too that if you are sitting on this um, YouTube or podcast, wherever you're watching this, and you bought an annuity 5 years ago, and you're like, "Holy crap, I got this wrong." Well, rest assured, nobody can time the market. Nobody can time the stock market. No different than timing the interest rate market or interest rate environment. However, just what, 2 or 3 episodes ago, we talked about replacing older annuities.
Mhm.
So if you bought an annuity 5 years ago for income, you can change that annuity. You can roll out of that annuity and buy a new annuity with today's higher interest rates that are going to correlate to your annuity payout rates. And chances are you're going to benefit in that upgrade substantially.
But for the
But
sake of, oh, go ahead. I'm sorry. Go ahead.
go ahead.
I would say for the sake of example, let's say I was really specific and I focused in on, meeting the criteria that we use as our annuity inspection, our multi-point annuity inspection. I said I wanted a carrier rating of A plus or higher. Just interested to see what income that would create.
Sure. So we'll come over here to the left and select the AM Best rating to only show us the annuities for A plus or higher.
Yeah, not far off.
And we're what, about $5,000 less to get that A plus rating, but still way more than back in 2020. Let's see on the report. I mean, A plus was Prudential, so Prudential is an A plus rated company, so they're at 65,431.
Yep.
So 65,431 now versus 87 to do an apples to apples. Here it is. There's their product.
Yep. Yep.
Prudential SurePath Income right there, second on the list.
Yep.
Pretty
Okay,
cool.
cool.
Not to mention, and we're going to talk about this in another segment on this episode, but the other thing that you're going to find that's also higher are the crediting rates on the index crediting strategies, the participation rates or the caps. So you benefit in both ways. You get higher payouts on the lifetime guarantee for income, and then you also benefit in the upgrade by having higher participation or cap rates on the index crediting strategy that sustains your account value long term. It's a death benefit and all these other features. So pretty cool.
Yeah, great example.
All right, so let's go back. Now we're going to look at MIGA rates, MIGAs, the multi-year guaranteed annuity. And
Let's
these,
define this product real quick. So multi-year guaranteed annuity, oftentimes maybe related to a CD-like structure, and that it's a time deposit vehicle, right? So we're getting ourselves a guaranteed rate for a designated period of time. And at the end of that term, we know exactly what to expect from it. No surprises. There's no market influence within that term. We know exactly what to expect from that earned interest in this product.
exactly. So this particular report was sorted when it was sent out to be ordered chronologically highest rate um, down to the lowest rate. So chronologically, the highest rate to the lowest. In this case, it was a 3.2% guaranteed rate for 10 years. That was the contract term. But we can also look at just the more shorter term or midterm would be around 3.1% at a 5-year guaranteed term. If we want to look at a 3-year, let's see if a 3 year is on here. This might have been a report that they specifically requested 5 to 10 years.
Right.
But 5 years, that's kind of the common middle ground. So let's compare the 5-year rates today. So we're at what, 3.1%? Or is it? Yeah,
There you go.
3.1% on a 5-year. This is a security benefit life insurance company. And now let's come in here and look at the top MIGA rates today. So these are sorted right now by term. So if we come down to the 5-year rate, the highest is now offered at 5.75. There actually are some other products that are not in this software that are even higher. Zach, I believe there's a Axionic
Yep. You've got
Life
uh
5.9, 5.99.
yeah, we've got a few others out there. Some of it's not here built into the software, but we do have access to them. It's just a matter of finding out what's important to our clients' needs. But if we can you go back to the one that was from 5 years ago?
Yeah, let me make sure we're looking at a Florida comparison too. So going back to the 5 years
Let's
ago,
just try to do an equal comparison. That product is an A-rated company. Doesn't say if we've got any withdrawal ability. Some of these will
it
have, oh,
it,
there
it
it is.
did it had 5%.
Okay, 5% free withdrawal. So let's use the tools that we've got,
Okay.
sort based on that criteria, and try to give ourselves that real apple to apple comparison.
So A rating or higher, And then withdrawals was 5%. We'll see if there's anything
Yeah,
higher.
there you go. Well, I mean, shoot, you could do interest only because it's over 5%.
That's true. That's a good point. Well, let's look at it this way first. So,
Yeah.
nationwide, A plus rated in the 5 year segment at five and a quarter.
Yeah. There we
So
go.
we're talking about, 2.05% higher interest each year for 5 years. And on top of that, that's a compounded growth rate.
Yep.
So one of the things that's often under discussed too, and many people don't know this, is that if you did buy a MIGA, a multi-year guaranteed annuity, they're also referred to as a fixed rate annuity. If you bought one 5 years ago, or maybe just a few years ago, but you're in a longer term contract, maybe it's 5 or 7 years, and you're not yet out of the surrender, well, you can replace those old MIGAs. Okay. There is a surrender penalty, but a simple back of the napkin calculation. So if you were in this product and it'd be a 5% surrender if you were in like the fourth year, but you're netting your first year would be a wash, but the second year you're actually netting that 2.05. So you're actually ahead of it versus staying in the old contract for that 2 more years essentially. Okay. In addition, you might miss the bus if you don't switch because you're worried about the surrender, and then interest rates come down, which a lot of economists are forecasting right now. You might miss the bus on the rate you could have got today. So, it comes down to working with an expert that can help you do the analysis and weigh out all your options. We're never going to recommend upgrading an annuity if it's not truly an upgrade. And I think that's important to note.
Yeah. And a lot of questions come around timing, right? So when's the right time to buy these annuities and when should I start looking? I think objectively, if I take our annuity hat off for a moment, we just look at the environment we're in. There's a lot of volatility going on right now. So we hit those points where we say, okay, is now the right time to consider an annuity? There's a lot of moving parts that come with that in terms of where somebody's at in their life and planning for retirement. But ultimately, like you said, we don't want to miss the bus. And there's a lot of economists that are projecting we see a shift here towards the end of the year. So, not saying now is the exact right time, but it might be the right time for somebody who's considering it.
Yeah, and I think I've had plenty of experience working with people that are hesitant, right? They just don't know when is the right time. And it's like anything else too. You're never going to time it right 100%. But you're also going to avoid regret if you don't try to make a decision. If you don't make a decision, you're going to have regret. So those three emotions, we talked about this on the behavioral psychology of retirement: fear, regret, and greed.
Mhm.
Those are the three emotions that get people in trouble. So there's always going to be one emotion present on any financial decision that you make. But I would rather have a fear emotion about if I'm making the right decision than stopping and not making that decision than having regret later. And, I think that's important. You just have to weigh it out. You have to understand that no one's going to time anything right. But I do know people that waited and hesitated. I don't think annuity rates are going to go up from here personally. My expert advice, I do this every day for a living. I look at these rates every day. I've been running annuity reports for almost a decade, and I'm telling you right now, the way I see it, I don't think rates are going to go higher from here. If anything, we've already seen a pullback
Yep.
in rates. I have clients last year. I was able to get them into a fixed rate annuity, a MIGA, at 6%. And we just now saw there were a couple products on the market that were at 6% or 6.05, and those just had rate adjustments, literally
Mhm.
like 3 days ago. downward.
Meaning they went down. Yep.
Yep, they went downward. So if you're in the market, definitely talk to somebody. We'd be happy to see how we can help, but definitely do something rather than nothing because we probably could bet that interest rates will go down.
Yeah, and these aren't just the only annuity types where we're seeing shifts or adjustments in rates. When we start to look at those fixed index annuities, they carry a different platform of how that crediting is occurring. So going into that a little bit, they don't credit interest in the traditional sense of what we were just referring to when we consider a MIGA, right? Instead, these carriers are using a portion of that return from their bond investments to create what would be called an options budget. And that's where we start dipping our toes more into a little bit of different crediting strategy.
Yeah, so let's understand the options budget in fixed indexed annuities. This is one of the most like literally misunderstood or most under discussed parts of a fixed indexed annuity. And it's one of the frequently asked questions that I get is how can an insurance company offer, these crediting rates or these caps or whatever on these popular indexes? How can they offer such high caps or high participations? And it comes down to understanding really the mechanics of a fixed indexed annuity and ultimately what the insurers are doing on their general account and what they're investing in and how they're creating this product because it's really unique and it's pretty, I think it's pretty brilliant ultimately to be able to offer, create this product that can offer guarantees on principal protection while still giving you favorable rates of return and fair rates of return with little to no risk. So basically, how it works, let's say you invest $100,000. The annuity provider or the insurance carrier is going to set a portion of that 100,000 over in reserves. And then the rest is going to get invested in bonds. So generally, the way I break it down is kind of using the 80-20 rule. They're going to take 80% of that 100,000 and they're going to go out and purchase corporate bonds. And then that's going to create a margin or a yield that they're then going to also leverage the remaining 20% of that initial premium. And they're going to go out and buy options on these indexes like the S&P 500. So that options budget is what actually gives somebody, the contract holder or contract owner, the ability to make really fair rates of return significantly above the highest fixed rate investment vehicles that can be had on the market. So, if you're looking at, let's say, a bank CD or even a MIGA, a MIGA right now you can get over upwards of 5.5, maybe close to 6%, depending on the carrier and the term. But generally, an indexed annuity can offer you anywhere from 2 to 3 percentage points in the right annuity, indexed annuity, above and beyond that highest fixed rate. But the way that it's created, that the way that that additional margin or yield is created is through these options and through these placements of those options on these popular indexes.
Yeah. So again, with that, you're really getting a guarantee of that principal protection. So if that option doesn't strike, or if the S&P is down significantly that year, what's your worst case scenario but a zero return? And the value with that fixed index annuities, you get to ride that wave back up when that index does return to where it once was and potentially beyond.
That's true. And if you look at the probability of a down year and then what follows it subsequently is going to be a very up year. And so the beauty of an indexed annuity is they have those annual or biannual reset features. And that reset is going to reestablish your starting point for your crediting rate so that you're now starting down at the lower point and you're able to ride all that upward momentum and capture it. So there's no having to wait to break even. You just have to wait for that reset. And it's like setting the bar lower of where you start, and then you get to ride that mountain back up. So
Yeah. So
Zach,
thank you
why don't
for
you talk
explaining that
about
because
the market linked upside there, and then kind of discuss what that options budget's used for.
Yeah, so going into that, yeah, with that explanation that you provided, that's really how they're able to provide you with that market linked upside, right? So without any of that downside risk, if the rates are high, they earn more interest, which will theoretically, it will boost up the options budget, which will provide the higher caps, which we're seeing right now, better participation rates and lower spreads. So in the current environment, again, just tying this all back together with these MIGA rates, fixed index annuities with that lifetime income, we're seeing higher rates in this environment, as well as fixed index annuities for growth.
Yeah, so to break that down just a bit more, what's actually occurring on the actuarial side of the table, which is where the insurance companies are very strong, if not the best at, and that's leveraging actuarial science and mathematics. What they're doing is they're leveraging now, when you have a higher interest rate environment, they can go out, the insurance company can go out and secure larger coupons or higher yielding coupons on a large bond block. So a bond block is like a large purchase of corporate bonds. And if it's a high interest rate environment, they can go out, they can use in that $100,000 scenario, they can use less of that initial premium to secure bonds because the bonds that they're buying in that current environment have a higher coupon or a higher yield overall than 5 years ago. So they can use less of that initial premium to go out and buy bonds to create a baseline of yield. That baseline of yield is like the foundation so that they can continue to pay their ongoing claims paying responsibility or obligation to the contract. But ultimately, what's happening is they're creating a foundation of yield that's secure and essentially guaranteed. And then what it's doing, because they can buy a higher yield or a higher yielding bond, that allows them or affords them to shift more of that initial premium investment to the options budget. So they can essentially buy more options, which have a higher probability to strike, which then translates to higher cap rates on the underlying index crediting strategy or higher participation rates or lower spreads. So because of the interest rate environment being higher, the way that it ultimately impacts a fixed indexed annuities pricing is because they can buy less bonds to provide that same foundation of yield, shift more into that options budget, which then translates to the consumer in their contract better participation rates and higher caps. So, and it works the adverse way when interest rates are low. So when there's less budget for the options because they had to go put more into the bonds to get the same amount of yield with the lower interest rate environment, your index crediting potential shrinks. So
Right.
it's all about that options budget. The more they can shift over there, the better.
Yeah.
Interest rates and the higher interest rates allow them to do that.
Yeah. Yeah. Thank you for providing that clarity.
Yeah,
Um,
absolutely.
and that
That was
also
one of the
brings us,
biggest questions I had when I was first starting in this industry was how in the world does this work? How can an insurance company offer a 200% participation rate above the actual performance?
and
So,
it brings us into a little bit of our meetings and the way we conduct our business as to, choosing the right fixed index annuity for an individual and what their criteria is in selecting that right product and, what's important in that decision-making process. So we'll dive into that a little bit towards the end here, but it'll brings us into why we take the process that we take with all of our clients.
exactly. So, that's going to segue into our next segment, which is about inflation and purchasing power. Inflation is one of those buzzwords right now, obviously, because it was so high the last few years due to the COVID crisis, right? But inflation is that silent killer. And over time, it's going to erode someone's purchasing power. And your money is ultimately your security. And the less purchasing power your money has, ultimately that means your income is also impacted in a negative way. So,
Yeah,
Zach,
and
why don't you explain kind of how that might work with an annuity income stream?
yeah, I mean, we saw a prime example, and when you shared your screen with us here of the difference of what that timetable looked like. We saw a change here in inflation, I'd say, between 2020 and today, and we saw how that impact can really affect somebody in our everyday lives. And then we take a look at what you shared there and what that income impact is as well. So really, when we look at that dollar value, a 30,000 annual income that we may get from an annuity today, 5, 10 years from now may change. The value of it may be less. Maybe that's 20,000 or 25,000 down the road.
Well, the value won't change, but the feeling of that 30,000 may change because of how high prices have gotten around us. So it might feel like it's 20,000, but it's still going to be the same 30,000.
Right.
It's
Right.
just the feeling around that money and how far that 30,000 goes is a lot less due to inflation.
Yeah.
But there are options when it comes to annuities. I'm a big advocate for securing the highest level guaranteed income stream you can find, and then using the rest of your assets to be your inflation buffer. That's the real optimization. You can secure annuities that have inflation adjusted riders or income that increases annually, but just know that the initial starting income amount will be significantly less or lower than if you went with just the pure level payment out of the gate. So there will be that like break even period. How long does it take for that inflation adjusted income to reach what the level payment would have been out of the gate? And most of the time, when we do the analysis, it's like 13 to 15 years. It's sort of similar to comparing Social Security. Like, should I take it at 62 or should I defer it at 70? Well, to answer that, there's two questions is are you healthy enough and are you wealthy enough? Those two questions are posed and asked because the healthy question is, are you going to be healthy enough to defer that to 70 and then benefit from the break even? You have to be alive for that to break even. And usually it's like 12 or 13 years in that scenario. If you defer to 70 and then turn it on versus if you took it at 62, it's like a 13-year break even period in most cases. So you need to make sure you're going to live to 83 to
Yeah.
even break even. And then above and beyond age 83, it's profit and a good decision. So that's always going to be more of a personal preference on whether you should do it. Obviously, the economics make sense if you're healthy to wait, but you obviously have to have other income sources to generate the income you need today while you defer that Social Security. But either way, the inflation adjusted riders are available on some annuities. I'm not a big proponent of those, but if you want to compare them, I'd be happy. Our team would be happy to do that with you and take you through that exercise. Other types of annuities, like an indexed annuity that has what we call a performance driven income rider, that's where the index's performance in the contract influences the lifetime income on an ongoing basis. Those are also something that you can consider. But again, I'm really big on planning around contractual guarantees, something that will actually happen, not what could happen. I don't like planning based on hypothetical scenarios, but there are ways to get creative and kind of incorporate a combination of these aforementioned strategies or riders that can help you pace inflation over time. But Zach, why don't you talk about another strategy that's kind of
Yeah.
attractive,
Yeah.
especially at this time with a high interest rate environment?
Yeah, one I'm actually working on right now with a couple clients, just taking a look to see if this is a better solution, is taking a laddered approach where we're designating a certain dollar amount in income for a block of time, and then we're activating another income source 5 years down the road. And what we're finding with that approach is it's getting them a guaranteed income for that period. Once we wait that 5 year period, we turn on the other income while it's being deferred. It's growing at a guaranteed rate. And that income amount is now producing a larger income than what we had initially set for that first block of time in 5 years. And they had approached me with a question about something that may provide or may be an inflationary tool. We said, okay, let's take a look at this and see if this works in your favor. And really, what we're doing is we're laddering these annuities and providing a different approach instead of just a one answer. It's getting a little bit creative in the approach there.
I love the idea of laddering annuities. I think it makes the most sense in order to optimize the income, give it an inflationary hedge over time. But what I really love about it the most is it gives a lot of flexibility and optionality about when and how much income you turn on and activate at different points in time in the future. So whenever somebody's working with us and they're considering putting in a fair amount of investment premium into an income annuity that's going to be deferred in some capacity. Let's say it's 500,000 or more, maybe $1 million. I love the idea of taking that premium and breaking it up into tranches, even if it's in the same product. You could take that same 500,000 and instead of having one contract with 500,000 in it, you could take five $100,000 contracts. And that just gives you a little bit more flexibility of when you turn on income and how much. And if you continue to defer those other contracts, you're actually benefiting because and also hedging inflation because those income rider contracts right now, especially with the high interest rate environment that we're in, those income benefits are growing by anywhere from 8 to 9% every year, guaranteed, not dictated by the markets whatsoever. So the way that I think it becomes really attractive is when we're doing the initial planning, people have an idea of how much income they're going to need or want, but sometimes there's some uncertainty. Like I might not need that much, or maybe they know exactly how much they want, but they're like, "Hey, I could need a little bit more. What do I do?" Or maybe that concern is just about inflation in general. Let's say you're thinking about putting 500,000, but you still have plenty of other monies to deal with. Maybe you do secure that initial $500,000 foundation to fill the gap and uh, give yourself that baseline of income you need for lifestyle sustainment, but you still want to benefit from hedging inflation. You could take another 100 or 200K, piece it out into these other annuities, and then keep deferring them every year. And those are going to grow at that 8 or 9% today. And you can defer those out. Some of these contracts you can defer out to 15 years. Some
Hmm.
of them are 20 years.
Yep.
But the common is 10. But um, I think it comes down to just getting creative. And then let's say you don't use them, right? Like you bought them for inflation, but your Social Security already has a cost of living adjustment on it. Maybe your stock portfolio does well over the next 10 years. There's no other better place to be, by the way, to hedge inflation than the stock market. That's where all the money ends up. So when inflation's high, stock prices go high. Okay. That's the best place to be to hedge inflation. But let's say you don't use these annuities. You bought them as an inflationary hedge, and then you get a little longer in the tooth of your retirement income plan, and you're like, hey, we've got these annuities. Well, guess what? You can cash them out, or you can keep them preserved. They're still growing according to the index crediting strategies on a non guaranteed basis that's building that account value and the death benefit that's associated with them. So when I say it gives you more optionality, you have more optionality long term, but also have that peace of mind knowing that sum of money was protected from risk and it could have acted as an inflation buffer if you needed it. And if you don't need it, you can cash it out or you can let it ride and then it becomes a legacy benefit to your loved ones. So I love that idea. I think that's very smart. In addition, we talked about this on that we're going to be launching this on this next episode that's coming out this Friday. We talked about long-term care annuities.
Hmm.
So if let's say you bought those annuities for inflation, but you didn't need them, but they had a long-term care enhanced income benefit rider. Well, now they just became a long-term care feather in your cap to help with those costs. So like there's tons of optionality that comes with that strategy of like putting a little bit more in the annuities and deferring them longer. And I really love that because there's nothing more powerful than knowing that, hey, this money was safe. It wasn't at risk unnecessarily. It's been growing at a guaranteed rate on the income side. If we don't need the income, it can be a long-term care play. If we don't need the long-term care play, it could be a death benefit play. Just so many benefits to it. And a lot of times people don't think of how to leverage the guarantees of these annuities in that way.
Yeah, and we've talked before about those retirement years and the ability to be dynamic. That retirement period is a dynamic time at which we can, things will change, things will shift. As much as we have a plan in place, life is dynamic. Things are changing all the time. So having that versatility and knowing that you can use these tools to your benefit in several different ways adds a huge value in that planning.
Yeah, absolutely. I love it. All right, let's go. Let's see what we got next. Next segment here, we're going to talk about really ultimately the strategy and the key takeaways here. So, my question to our audience is how do you actually use all of this economic data that's at your disposal to make a smart annuity buying decision?
Yeah, so from our end of it at Annuity Association, one thing that we're considering if somebody's thinking about retirement and what that future might look like starts with understanding the current landscape, right? So understanding, are interest rates high right now? Is volatility a stressor in your day in and day out in planning for retirement, or your thought process around and approaching retirement in the next 5 or 10 years? Are there concerns around inflation? So we think about all that. We take a look at that from our meeting structure when we speak with clients and find out where those concerns are so that we can help in any way possible to see if an annuity can be that piece of the puzzle to assist.
Absolutely. Hey, I really liked that we talked about laddering annuities. I think we should have another episode just on that because that can go 40 minutes, man, just talking about it.
Yeah. Oh
And I
yeah.
think there's a lot of value in that, especially with the interest rate environment we're in.
Yeah, without a doubt.
So, long story short, it's going to come down to understanding the right way to evaluate annuities. We do that through our multi-point annuity inspection. We help you understand if it's an income play, what the strongest income guarantees are out there for your situation. We help you consider and compare carrier ratings, the index growth potential if it's a growth play or an account value sustainment play with an income rider. We talk about and compare rider fees themselves and how and the impact those rider fees have on your overall annuity account value. And then last but not least, we talk about your long-term care enhanced income benefits and whether it's something you can value from. And if so, how much are you giving up on the lifetime guarantee to get and secure those long-term care enhancements? And that's really it. So we're very passionate about what we do. We're advocates for annuities. We're advocates for lifetime income. We're mainly and mostly, most importantly, rather, advocates for the appropriate application of an annuity in an overall retirement plan. We're not here to just sell you an annuity. We actually despise the people in our industry that are selling annuities wrongly. Okay. And we're actually really passionate about, and our ultimate mission is to right the wrongs of our industry. And that's one of the big ones. And we're ultimately trying to bring more transparency and education to this subject matter so that people can make better annuity buying decisions, but ultimately improve their financial picture in retirement. Because with that shift from pensions years ago to now, all the risk is on your shoulders to disperse your funds and generate income. That's a tall task. And I don't think a lot of people out there understand the magnitude of that task and the impact it can have in a negative way if you get it wrong. And annuities address and mitigate the key risks that are associated with income disbursement or income generation or converting your assets to income. Annuities are very key and pivotal in the role they play in mitigating those risks that are associated with that. So, if you love what you've heard today, you're benefiting from it, please give us a thumbs up, a like, and share. We would appreciate it. It helps bring awareness to our channel and ultimately to our mission. And if you'd like to work with us directly, we would be honored to see how we can help serve you in retirement. You can do that by visiting our website, but or go to the show notes or description here. There'll be a unique link that you can book your free annuity discovery meeting with a subject matter expert like Zach, who is a member of annuityassociation.com. Or you maybe aren't ready to schedule a meeting quite yet, you're wanting to lift your annuity IQ, you can do that by requesting your free annuity report, There will be a link in this show notes here as well where you can request your free annuity report, and we will tailor that to your specific situation and send that out within 24 to 48 hours.
Yeah, just remember, from our end of it, the way we conduct our business is by providing that education upfront and the information upfront. There's no cost or no expense that comes with that. Ultimately, like what Jeremiah was saying, is that from our end of it, it's righting the wrongs of the industry. And what we've really found is that there's a lack of education that's being brought to the forefront. And that's really where we want to be. We want to be in the forefront of providing that education and the information so that when that decision comes, you've made the right decision. If an annuity is the right choice for you and your family. So if you'd like to get more education and more information around annuities, that's what we're here for.
Absolutely. Well, thank you for tuning in to another exciting episode of the I Love Annuities podcast. This is Jeremiah Conjure along with my co host,
Zachary Van Ness,
and we are the
the
Annuity
annuity
Dude
dude.
signing off. Got that Barry, was that Barry White? This is the Annuity Dude signing off.
Be
Be
like
good out
Delilah
there.
after dark.
Be good out there, boys and girls. All right, everyone, have a great day. Take care of one another. Thank you so much. How do we stop this? Here we go.